Hi, we are joined by Niraj Didwania. He's the head of corporate development and investor relations at Healthcare Global. Niraj, your numbers came out, so won't speak too much about that. But let's talk about the future outlook. Two of your facilities, that is the Nagpur as well as Borivali facilities, have recently commissioned and they've started operation. Tell us what's the update there? How is progress there? What kind of growth outlook are you looking there?
So, typically what we've maintained is most of our new facilities, they generally break even between 12 to 15 months. I think from Mumbai perspective, we've given a guidance of about 18 months because there is high rent.
Okay.
But both these markets are very large private cancer markets.
Okay.
So what we are doing is it's in line with our strategy to go hybrid, which is have dual presence in metros and also tier 2, tier 3 towns.
Okay.
So far, I think we're very enthused by the performance of these centers, and they are ramping up well. They are on track. In fact, from Q3 to Q4, we've seen growth in revenues and reduction in losses from them. So I think they should be in line, and they will be another positive boost for us in the next couple of quarters in terms of once they break even.
Okay. You recently exited from the Kanpur facility. Are there any other such facilities that you're looking to exit?
So if you see right from the IPO time, there were a couple of facilities that we were restructuring. In 2017 March, Delhi, where we had an implant model, we did not renew that contract. We've guided in the last 1 year, Trichy has been in restructuring. So both of these were implant models, which slowly we don't want to do. We want to do dedicated standalone cancer centers. These implants in a multi-speciality only doing cancer has not been very profitable, although we have two successful models there. Kanpur, the thing was that we are very return centric also. So what we figured out in Kanpur was that the patient profile was not really what is our target audience. There was a far more proportion of scheme patients. So we felt that the return ratios and the metric for us will sort of be far more stretched out than our internal benchmarks. And given sort of the things we have on our plate from a prioritization perspective, we felt that there is better use of that capital. So and we had a partner who is only focused on that region. So Regency Healthcare is a UP focused healthcare chain, and so they are focusing on that target audience. So we felt that it was better that they take it forward while we have other centers coming up. In fact, 6 more launches. So there are no other centers like that. I think we've never exited a center on commercial grounds. This is more about what we have as internal benchmarks.
Okay.
And that's what the decision was.
Okay. What about margins? Over the past few quarters, it's been very range bound. What's the reason and what's the outlook now?
So you're right, at a consolidated level, we've had some impact from the new centers that open up. If you see on a year-on-year March ended, for the quarter, we had a margin expansion year-on-year basis from 19.3 to 19.6% for the existing centers.
Okay.
This is post-corporate expenses. And for the whole year, it's been 1.1% margin expansion from 17.5 to 18.6. So I think our existing businesses are on a good margin expansion spree. A little bit impact will happen from the new centers, and there are centers that are opening up every quarter, and they do have a little bit drag. But I think at an overall level, we will be in this range that we are in currently.
Yeah. So over the next, let's say, few quarters, which are the new centers or hospitals that will be operational? So
as in the current Q1 FY19, we have 2 centers. One is the Nasik Phase 2 expansion.
Okay.
And second is Jaipur. Then in Q2, we will be followed up by Calcutta. And Q3, we will have South Mumbai, which is another flagship, very nicely located center. So in the current next 12 months, we will have these 4 centers open up, and that will leave only the balance 2 centers, which is Kochi and Gurgaon. That will come in FY20.
So what's the Capex plan like? Because you have significant amount of hospitals coming in. How funded are you, and what's the Capex requirement?
So a substantial portion of our Capex is in the equipments for cancer care, which is linear accelerator and PET-CT. Both these equipments are funded by the vendors themselves. So we have a 3-year period for which we don't have any cash outflow against these equipment, and that constitutes 40-45% of the total Capex.
Okay.
Apart from that, the balance investment is funded by a combination of some cash we have on our books, some internal accruals, and also we raise some debt. So at this point, if you look at the serviceable loan to EBITDA, it's roughly under 2 or around 2 times. So we are very healthy. We are A negative. So at this point, for the committed Capex, we are very well funded.
Are you looking at therapies beyond oncology, or are you looking to just stay cancer centric at this point of time?
So see, our deepest focus will remain cancer. It contributes 80% of our revenues. And our group is a onco-focused group. Our founders were oncologists. So, that is going to be our number one focus area. About a few years back, we did enter fertility, where we own majority in a fertility chain by the brand name of Milan. And we find that as a very high potential niche where, we are among the market leaders there. So we want to grow that. Apart from that, I think, with these two itself, next few years of growth is in both these verticals are there. But we remain a doctors owned enterprise and a doctors group. So if we find specialities where there is huge potential going forward and driven by a set of, passionate and good clinical doctors, maybe we could look at it, but nothing in the immediate future.
Okay, and before we wrap up the interview, what's the guidance for FY19? Leave us with some numbers. What are you looking at in terms of top line, bottom line, margins? If you can leave us with some numbers.
We don't give future guidance, but what I can say is if you look at FY18, we've been growing about 20% on the revenue side. Our existing centers, out of that 20%, about existing centers have contributed 12.5% of growth, both on revenue and EBITDA. And the balance growth is the new centers. So we have had 6 hospitals open since IPO. 3 have broken even, 2 are under 1 year, so they are tracking well. And we have 5 or 6 open more. So we are in the second phase of our expansion, and our capex and debt should peak in the current year. And going forward, then I think we should have that inflection point where no more new centers or few centers are opening over. There are a base of a very strong, mature hospital set. So that should be the inflection point for us.
No, but what about the bottom line, the margins? What about debt reduction? What's the guidance on that front for FY19?
So I'll continue from the sort of call that we had last week. Our capex for the current year is probably going to be 60-70% of what we did last year. So it's going to peak out, and that's also going to have a peak out on our debt. And really, we don't give FY19 numbers in terms of as a policy not allowed to say any numbers. But what we feel is we should be able to continue this growth, both in existing centers and new centers should add the fillip on the existing base. And FY19 should be the year where we peak out on the capex and the debt.
Okay, we'll leave it at that. Niraj, thank you so much for speaking to Bloomberg.
Thank you.
Bloomberg Quint.